While market and limit orders are most commonly used by investors, there are other types of orders that may suit your needs. In this video, we will review the various types of stop orders. Stops and trailing stops can help add flexibility to trading. They can also help limit losses, protect profit, and they can be used to enter into positions based on momentum. Before we go over each type, let's address one question first. What does it mean to use a stop in an order? A stop, or a stop loss, is a traditional way of saying that an investor is looking to limit loss on their trade, and it's most commonly used on sell orders when they're holding an existing stock or ETF. We know from our last lesson on limit orders that if an investor wants to sell their stock, they can enter a limit price that's higher than the current market price of that stock. They do this to try and take profit when the stock rises to a certain target price. For example, if ABC1 stock is currently $50 per share, then an investor may enter a limit order to sell at $55. By doing this, they are seeking to exit and increase their proceeds by $5 a share. With a stop loss, instead of entering a sell price that's higher than current market price, the investor could enter a price that's lower instead. Like $40, not $55, $10 less than the current market price. The $40 is called a trigger price, and the order may be executed immediately, as soon as the stock dropped to or through the amount. But this depends on which type of stop order you are using. Now, there are two types of standard stops: stop market and stop limit. Let's go over stop market first. A stop market gives investors an opportunity to set in advance the trigger price that activates a market order to buy or sell a stock. Let's look at a commonly used example, a sell order. Let's say you bought a stock at $60 a share right before going on vacation. Because you may not be able to keep an eye on your portfolio while you're away, you may want to set up a stop loss sell order. This could help you exit your position and limit loss if the stock drops in price. This is called selling on stop. If you decide that you want to sell your shares when the stock goes down $15 a share, then you could set up a stop trigger price of $45. This means that if their stock were to drop to $45 or below, then the order would be triggered and the stock would be sold at the prevailing market price. Although you set a trigger price of $45, it's important to note that you aren't guaranteed $45 for the sale. In fact, the sale price is unknown. Why is that? This is because the stock could be trading at any price after it triggers. This can be amplified the more volatile a stock is. For example, if the trigger was activated at $45, the stock could drop beyond $45 to $40. This means that when the order is filled, you will receive $40 for the sale. On the other hand, the stock could be trading at a slightly higher price after it triggers. Because the order becomes a market order after being triggered, the stock is sold at the best available market price, and it could be at any price. Needless to say, if you're considering a stop market order, make sure you're comfortable taking on some risk with the unknown price factor. You may also want to consider exercising increased caution if you're thinking about placing a stop market order on stocks that typically see more daily movement in price. Stop limit orders, on the other hand, may offer a little more control on that front, but they can reduce the likelihood of the order being filled. This is because a stop limit lets you select not only a trigger price, but a limit price as well. This is the bare minimum amount you are willing to accept for the sale of an investment, or the maximum amount you are willing to pay for a buy. For example, on a stop limit sell order, the trigger might be $45 and the limit price might be $43. The order is triggered once the stock drops to or below $45. If the new stock price is at or above $43, then the limit order is filled. However, if the price drops down below $43, like to $40 or $35, then the stop limit sell order remains open. At this point, you need to wait for the stock price to rise back up to or above the limit price of $43 before the order is filled. For this stop limit order, the execution is guaranteed to be no less than $43. So, with a stop market, the order is executed at the best available market price as soon as the stock price drops to or below the trigger price, but the exact price of the execution is uncertain. However, While a stop limit may give you a little more control over the price execution, the length of time it takes to fill an order is uncertain. If the stock drops below the limit price in a sell order, or if the stock rises above the limit price in a buy order, the order remains open and you may have to wait some time before it is filled. There are many reasons why a stock would rise and fall drastically beyond the trigger price. For example, a company may make a major announcement about their earnings or product offerings. If consumer sentiment is widespread and either positive or negative, then the stock may spike upwards or drop. We talked a little bit about why we would use a stop on a sell order. But what about a buy order? There are a couple reasons why an investor may use a buy on stop. One of those reasons is to buy on upward momentum. If a stock you're interested in buying starts rising and you believe it will continue to rise, then you may use a stop. For example, if you see that a stock rose to $60 and you believe it will only continue to rise if it passes $62, then you may enter a buy on stop with a trigger price of $62. Once the stock rises to or above 62, you will buy the stock at the prevailing market price. If you just enter a trigger price, then your buy order is a stop market. If you enter a trigger price as well as a limit price, then it's a stop limit. With a stop limit, once the price gets triggered, then a limit order is sent to purchase the stock at the limit price or cheaper. Another reason why some may use buy on stop orders is if they are short selling a stock with the goal of making money when the price drops. Buying a stop order in this case may help provide them with more protection. If the stock goes up in price, it could potentially lead to a lower return. As you can see, stop market and stop limit may offer a little more flexibility to an order, potentially more than with a market order and a limit order. You may be able to add more flexibility by using a trailing stop. This is because a trailing stop works exactly as it sounds. It trails or follows the movement of the stock price. Remember that with a stop market sell order, you enter a trigger price below the market price of the stock. If the stock drops to or below the trigger, your sell order is filled. The trigger price that you set with stop market and stop limit are fixed prices. No matter how high or low the stock goes, the trigger price will be the number you set it to, unless you later went back to change your order. But with a trailing stop sell order, the trigger price automatically rises and follows the stock price. Let's see how this works. If you own stock that is currently $50, you may enter a trailing stop market sell order with a trigger delta of $1. Delta represents the change in price that you would like the order to track. For example, a delta of $1 means you're looking for a $1 drop in stock price from the current market price. So, if the stock costs $50 now, your order will trigger when it falls by $1 to $49. The system automatically calculates this value once the order is sent through our platforms. What if the stock rises instead of falls? If the stock moves from $50 to $55 without ever dipping down to $49, the $1 delta means you are still looking for that $1 drop in price. This means that your sell order may be triggered at $54 now, not $49 like before. If the stock keeps rising and eventually goes up to $100, the new trigger is, you guessed it, $99, $1 less than $100. The price only gets adjusted when there is upwards movement on a sell order. And it's the opposite case on a buy trailing stop order. A trailing stop market order can enable you to sell your stock whenever that stock drops by $1 or more. If the stock rises, the trigger price automatically adjusts upwards and continues to wait for that $1 drop in stock price. This can help investors to lock in potential profits, while also helping to protect from any downward movement. In WebBroker, you may enter a delta in dollars or as a percentage. If you set a trailing stop delta at 5%, for example, then the order is triggered once the stock drops by 5% or more. As you can see, stops and trailing stops may provide more flexibility to manage orders. But like anything related to investing, it's important that you take time to understand how these order types work and that you're comfortable with the nuances.